Hello, smart viewer of the CapitalCraft channel. Yes, I'm talking directly to you. Ever wonder how many mysteries surround your money in banks? What if I told you much is hidden behind the curtains of major financial institutions? Today, we'll dive deep into this universe and uncover what they don't want you to know. This is the channel that always brings the truth. And trust me, today's revelation will leave you stunned. Ready to unlock the most guarded secrets of the finance world? Oh, and here's a hint. Throughout the video, I'll be sharing some special insights that I believe will be invaluable for all of us. Stay tuned and don't miss out. Ready? The truth about your money in the bank. Ever deposited money into a savings account and felt some satisfaction seeing interest adding a few dollars? Seems like a good deal at first glance, right? But the reality might be more intricate than you think. Now imagine you deposited $1,000 in January, and by year's end, thanks to interest, you have $1,030, a gain of $30. Sounds great, right? However, many of us forget to factor in inflation, the rate at which money's value diminishes over time. Let's say the inflation that year was 4%. This means what you could buy for $1,000 in January now costs $1,040 in December. So even with that extra $30, your purchasing power has decreased. This is one of the secrets banks tend not to advertise. Because even if you're technically earning from interest, inflation might be eroding those earnings, sometimes even more so. Here's a practical example. Imagine wanting to buy an appliance for $1,000 in January, but you decide to save that money in the bank. By December, thanks to inflation, that same product now costs $1,040, and you only have $1,030. You're effectively $10 poorer than in January, even after saving and earning interest. It's crucial to understand this number game to truly protect and maximize your financial assets. Dig deeper, do the math, and look beyond the bank's shiny advertisements. The magic of fractional reserve. Ever been to a magic show and wondered how the magician pulled off that incredible trick? Well, banks have their own trick called fractional reserve. Imagine depositing $1,000. Instead of holding this intact, the bank only needs to keep a small percentage and can lend the rest. From your original deposit, a portion is loaned out, which is then deposited, and a part of that is lent again, and so on. Here's a simple example. Let's say the bank has a 10% reserve rate. From a $1,000 deposit, they keep $100 and lend out $900. This person spends the $900, and whoever receives it deposits it back into the bank. Now, the bank keeps 10% of those $900, which is $90, and lends the remaining $810. This process continues, and in the end, an initial $1,000 deposit can create much more money in the banking system. Now, think about this. Fractional reserve is a delicate balancing act. When all goes well, it's a money-creating machine, aiding economic growth. But the real question is, what happens if trust breaks down? What if everyone suddenly decides to withdraw their money? It's happened worldwide and is termed a bank run. This system, built on trust and this magic trick, can quickly crumble. From a sturdy, lucrative structure, it can become a fragile house of cards in a blink. As tempting as it might be to admire the magic, it's essential to know the ins and outs and the risks involved to not get caught off guard. Why the rich pay less interest? It feels almost paradoxical, right? Those who least need loans get the best rates. Picture this. You're in a store and two customers are buying the same product. One's wealthy, the other not so much. Now, imagine the seller offers an exclusive discount for the wealthy customer. Unfair, right? But that's precisely how the banking world operates. Take, for instance, Mark Zuckerberg, Facebook's founder. Despite being a billionaire, he took out a loan to buy a home. Why? because he secured an ultra-low interest rate, far lower than the average person. Instead of using his money, he took the loan, invested his money elsewhere, and achieved higher returns. Banks see the rich as low-risk investments. They believe wealthy individuals are more likely to pay back without issues, hence the lower interest rates. But here's the kicker. With the right financial education and strategy, you too can position yourself favorably against banks and perhaps secure those lower rates for yourself. Credit cards, friend or foe? Credit cards. Convenient, modern, and dangerous? Let's discuss how this small piece of plastic can be your best ally or worst financial enemy. Did you know the way you use it can determine your financial success? If you use it wisely, get benefits, and pay off the full balance every month, it's a powerful tool. However,